building equity and everything is just fine. But when things slow down, you're gonna be the first to pay the price. And this money is not gonna take you to 85 years old. You're gonna be broke in your golden years of retirement. Millennials have more cost than any previous generation. What's up everybody, I am Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. As a millennial who loves talking about financial education, you can say I'm kind of passionate about millennials and money. And today we're doing a deep dive into millennials and finances because I put together some of our best clips where I go over why millennials are financially screwed, and I'm going to go over the things that you can do to get financially unscrewed, because right now a lot of millennials are struggling financially, and I'm going to be showing you the things that you can do right now. That way you can get out of this financial mess and start to build your wealth. So let's get into it. The media loves talking about why millennials are financially screwed because millennials spend all their money on AirPods and Lululemon leggings and extra guac at Chipotle. But there's more to the story than that. I mean, on one hand, we have a higher cost of living. That's why your housing prices and your rent payments keep going up. We have a higher standard of living, and we have wages that aren't keeping up. That's a very bad combination when people are trying to save money to buy a home. It's very hard when people are trying to save money for retirement, and it's very hard when people are trying to save money to build their own wealth when the cost of everything around you keeps growing way faster than how much money you're making. That might partially be why the average millennial is only worth $8,000. They're still relying on their parents for money. They have very little money in their savings, and they have next to nothing saved up in their investment accounts. Let me show you what I mean by looking at some average numbers so you understand the average millennial. Now, I know if you're subscribed to the Minority Mindset YouTube channel, the goal is not to be average. But for the sake of this example, let's look at the average millennial, because the average person between the ages of 25 to 34 is currently making a salary of $47,736 a year. This is the median salary between people between the age of 25 and 34. And you got to understand this also includes people who are doctors, who are professionals, who are attorneys making a lot of money. So that can kind of skew this number up because you have professionals and you have people who don't have a college degree all kind of wrapped up in this number. But the average person between the ages of 25 and 34 is making just over $47,000 a year, but you don't get to keep all of this money, right? I mean, the IRS, the government wants their cut. And so if you are living in an average tax state, so assuming you're not living in New York or California where you have very high taxes, you will be paying something like $9,500 a year in taxes on this, which would leave you with right around $38,500. I know I'm rounding a little bit here, but this is how much money you will be left with every single year, assuming you're making an average salary. I just cleaned this off to make it a little bit easier to see, but you have $38,500 a year to play with, which is right around $3,200 a month. Now, the first cost everybody's got to pay is you got to pay for your housing. The average apartment, one bedroom apartment in the United States is $1,200 a month. So if you're an average millennial, you might be living at a $1,200 a month apartment, plus adding another $100 or so for utilities. That's your gas, your electric, your water. I'm being kind of conservative here. So your housing costs right around $1,300 a month. Then you got to pay for your car, and the average person has a car payment. Now, if you go out and you finance a brand new car, it's going to cost you like $550 a month. That's the average price for a brand new car. So I'm going to assume that you're a little bit conservative here, and you're going out and you are financing a used car. The average payment on a used car is $380 a month. Add in your insurance and your gas, and let's assume that you're paying $450 a month for your car payment, your insurance, and your gas. Now, in order for you to get this good salary, chances are you went to college to get a degree, and if you're like the average millennial, you didn't have tens of thousands of dollars in your bank account to fund your college education, so you went into debt with student loans to fund your college degree, which is why the average student loan payment is $393 a month. Then you gotta pay for your extra guac at Chipotle, you gotta pay for your avocado toast, and you gotta pay for your Starbucks. The average millennial is spending like $140 a month on eating out, and then another $185 a month on groceries, which adds up to right around $325 a month on food. By the way, this is assuming that you're not shopping at Whole Foods paying $11 for organic soy milk. Then if you're like the average millennial, you have a smartphone, which you're financing, and then you gotta pay for your phone plan, and then all the subscriptions for the apps on your phone, like Netflix and Hulu and Spotify. So that, I'm assuming you are now conservative with this, because many people are paying more than $200 a month just on their subscriptions, not including their phone payments. But I'm going to assume that you're conservative, which is why your phone plan and all the media that you're consuming is costing you $180 a month. By the way, I threw your internet costs in here too, because no millennial, myself included, can survive without Wi-Fi, and this leaves me with your health costs. This is your health insurance, your gym membership, and whatever else you're spending on to take care of your health. This is costing you, on average, something like $300 a month. Let me throw one more cost in there too, because if you are a millennial, chances are you've heard of people investing in their 401k, and if you're trying to get ahead in the investing game, let's assume that you're putting 3% of your gross income. So not your $38,500, the gross income, the $47,000 that you're making, you're putting 3% of that into your 401k, which is another $120 a month. I don't know why I wrote month for these three but not the others, but you get the idea. If we add all these expenses up, your expenses every month are gonna cost you $3,068 a month, which means you have less than $140 a month every month to pay for your savings, to pay for your investments outside of your 401k, to pay for your vacations, to pay for your birthdays, to pay for your baby showers, to pay for gifts for your mom, and to pay for everything else. And this is assuming that you've been smart with your money and you have no credit card debt, because the average millennial has something like $4,800 worth of credit card debt, and I couldn't factor that average credit card debt into this, because now if you had an average credit card debt payment, then you wouldn't have enough money to even pay your bills. Believe it or not, these are what the average financials look like for the average millennial who went to college to get a good job because they're making a good salary, but all of their money is going out. And I'm being a little bit conservative here, because I'm assuming you're not driving a brand new car, I'm assuming you don't have $200 in just subscriptions like some people do, and I'm assuming that you never racked up any credit card debt. And these average numbers will explain why the average millennial struggles to save up for a down payment on a home, why it's so hard for a millennial to save up a savings account, and why it's so hard for people to start investing their money outside of the 401k, because the average millennial just doesn't have a lot of money left over after paying for all these average expenses. This doesn't mean that all hope is lost. I'll get to that in just a minute, but this is where we have to kind of really make a decision, because yeah, we can blame this problem on society, we can blame this problem on the government, we can blame this problem on the Federal Reserve Bank, but none of these things really solve the issue of what's going on. So we gotta really understand what is causing this, because there is obviously an issue of wages not growing fast enough. There's an issue of our cost of living rising very quickly, but there's more to it than that. There's a little bit of a cultural issue involved here too. Over the years, we've seen a huge growth in people spending money on things that they don't need. But this trend is not slowing down. It is only intensifying, and it is getting even more difficult for the average millennial to break out of the system because of this culture, and now all the kind of tools that are coming in, which make it even easier for you to buy something now and worry about the price later. The average millennial does not have a bunch of cash in the bank account to go out and buy big things or expensive things or nice things or even smaller things nowadays, which is why we've seen a huge boom in the whole industry of buy now, pay later, or as we like to call it here, broke now, broke later. First, it was credit card debt, because everybody would get a credit card, and if you didn't know how to use your credit card the right way, then you could easily rack up credit card debt. But I think people have become a little bit more aware as to the dangers and risks of credit cards if you don't know how to use it the right way. But now it's getting even worse with the growth of these buy now, pay later systems. Companies like Afterpay and Affirm and PayPal, which allow you to buy now and pay for whatever you're buying later, have been booming, and they expect to do something like $1 trillion of transactions by just 2025. The real scary thing about these platforms is that they're so new, so most people, the average person, does not understand the dangers and the risks and the costs associated with them like we do with credit cards. Because the way they work is you go shopping online, you find this new wardrobe, you find this new sweater that you want to buy, and you go to the checkout page, and then it says, do you want to pay for this sweater later? Because now all you got to do is pay for this $80 sweater in 3 installments, and you don't even realize the small interest that you're going to pay on on it. And so all you gotta do is click that button, because these platforms just integrate with all these e-commerce stores, so you can buy whatever you want and just pay for it later. And now everything that you're shopping for, everything that you're buying online, you're paying a little bit of interest on, and you don't even realize it. And now everything that you're buying, from your clothes to your furniture and maybe even groceries, you're financing. Now anytime you make money, your money is immediately going out, which leaves nothing for you, because you gotta pay for all that stuff you bought last year today. You know, we're a culture that really drives and thrives on emotion, where right now, if you want something, you gotta have it. And when you gotta have it, you gotta have it now. You know what that means? Financing it and worrying about the cost later. Because this is kind of the mindset that we have. It's the instant gratification mindset, where when we want something, we want it right now. And we're not going to save up the cash to buy it when we can afford it. We're just going to buy it right now and worry about the price later, because who cares about our finances next year? We'll worry about it then. Couple that with the Instagram social media flex culture, where when people see somebody else on Instagram having nice things, they want to one-up them. Because when you see your cousin Bunty driving around with his brand new Beamer or his brand new Gucci scarf, what do you want to do? You want to go and get a brand new Beamer or a better Gucci scarf. And how do you pay for it? Well, you finance it. So on one hand, we have this cultural spending issue where it is cool and it is normalized to spend all your money on nice things and to go into debt to have your nice things, because that's just what everybody does. And if you don't do that, you're a weirdo. And then on the other hand, we have this shift in our economy and the job market, because so many millennials have already racked up so much student loans to get a degree, to get a job, where nowadays many people don't even need that degree to get that same job paying the same amount of money. Our economy and the way our economy works is really starting to go through a shift right now, because many people are realizing that college does not have the same value that it did before. Now, obviously, college is important, especially for certain professions. Like if you want to enter the STEM field, if you want to become a doctor, a lawyer, an engineer, you gotta go through college. But a lot of people are starting to realize that if you don't know what you want to do out of high school, maybe you can go and get a job or go and take a year off doing something else and learn without going to college, or maybe go to community college. And so you have this whole kind of batch of millennials that went through college because that was just kind of the thing to do. If you don't know what you want to do, just go to college. And when you're 18, you kind of just sign your life away with an unlimited amount of student loans, because people didn't understand the dangers and the cost of student loans. And only now are we really starting to see that. And this really became amplified during the 2020 pandemic, because people are paying tens of thousands of dollars to go to these prestigious schools, where now you can just take all of your classes online. And when you're going to your classes online, you're still paying $40,000 a year as you would as if you were just sitting in the classroom. And people are starting to realize that that makes no sense. And so this is kind of really starting to make a shift in the college culture. Where is college important? When will it be important? And at the same time, you have so many companies that are dropping their college degree requirement, because they understand that you're going to have to learn the skills at the job. And I can tell you this from my perspective too, because I'm an employer. But more and more employers are now not looking for degrees. They're just looking for what you know, what you're passionate about, and what your skills are in. And so if you can learn how to do something and be good at it because you're passionate about it, now you're just as qualified as an employee who got a degree. I really think and I hope that we see a big shift in our college and higher education this decade, because millennials have been so fed up with student loans. And on the other side of things, people are wondering, why are they paying so much for college when you can attend the exact same classes online from your home? Couple that deep-seated spending culture with that changing job culture, with now an economy where the cost of living keeps going up and up and up, and this puts millennials in a really tough space. I mean, don't even get me started about what a retirement is going to look like when it comes time for millennials to retire, because pensions are no longer a thing for millennials. Social Security is drying up, and millennials, for the majority of people, are only investing their money in their 401k, when your 401k was never intended to be your sole investment or retirement account. And many millennials are not even doing that. Now, while this might not sound like good news for the average millennial, the good news is you do not have to be like the average person. I mean, if we just come back and we take a look at some of these expenses, you can cut some of these expenses down. That's one of the first things you gotta do. One of the easiest ways to keep more money in your wallet, to keep more money for yourself, is to cut down some of these expenses. Live in a smaller home. Live in a studio apartment. Do what you gotta do. Share an apartment. That way you can save half of this money right there. Your car. Stop financing your car. What I want you to do is find a used car that's in good working condition and buy it with cash. $5,000 can buy you a pretty decent working car. Then your student loans, you gotta pay off your student loans, so there's nothing you can really do there. With your food, stop paying for extra guac at Chipotle. What I want you to do with your food is now go to the store, buy yourself an 83-cent avocado, and make your guacamole at home. Then, when it comes to your phone and media, stop financing your phone, stop putting everything on a payment plan, and cut out some of the subscriptions that you don't use, because chances are you got at least one subscription that you're paying for that you're not using. Then, with your health, you got to take care of your health. Not much you can do there. And with your 401k, continue to invest your money. But if you at least make some of these cuts, you're going to have a little bit more money every single month. That way now, you have some more money to put towards your savings and to put towards your regular investments. Once you work on reducing these costs, then what I want you to do is work on this income. Maybe you can get a raise at your job, maybe you take on a second job, or maybe you add in a side hustle or a side business. That way you can create more income. But here's the thing, as you start to make more money, do not fall into the trap of you make more money and then you start increasing your costs. For a little while, start making more money here, keep your costs the same, and put all of this money towards your investments. That way now, you're working to create more income, you're working to build your wealth, and you're adding more money to that. That way you can really build this freedom, because if you don't start taking care of it now, somebody, that means you, is gonna pay the price later. And that's why you wanna be smart now. Start cutting down some of these expenses so you have more money, and then work on increasing this income. That way you have more money going to actually build your wealth. Because if you continue to live paycheck to paycheck with no money left over every single month, you are gonna pay the price later, and you don't want to deal with that. So start taking care of it now. Before we get into the next clip, if you do want to learn more about money management and investing, you can download our free PDF when you sign up for our newsletter. So if you want to learn more about that, I'll put the link to that PDF in the description below. Millennials were really dealt the short end of the stick, because between 1970 and now, wages have gone up by around 70%, which is good news. But do you know what has gone up by more than 70% since 1970? Your rent costs, your housing prices, your college costs, and your standard of living. Wages have been going up, but wages aren't growing fast enough to keep up with inflation and to keep up with the rising cost of living. That's why somebody who's graduating school today and enters the workforce getting an average job does not have the same buying power or the same financial ability as your parents or your grandparents did when they entered the workforce, even though they might not have gone through as much schooling as you did. But if we stick on the idea of home ownership is the American dream. That's why everybody keeps telling you to buy a home. Your parents, your uncles, your bank, the government, Wall Street. Banks will do whatever they can to get you qualified for a mortgage. So they will lower their down payment requirement, and they will try to look around your student loans. That way they can get you qualified for a mortgage. Same with the government. The government wants you to be a homeowner, so the government will try to create as many programs as possible to give you assistance. That way you can go out and buy a home. And Wall Street loves it when you go out and buy a home, because now they're gonna get these mortgages and they're gonna chop them up and sell them and sell insurance on the same mortgages and create this whole system and whole industry around buying and selling the mortgages that you took out. In good times, no one sees anything wrong with you buying a home that you can't necessarily afford, because everything is going up. Home prices are going up, so you're building wealth and you're building equity in your home. You are living the American dream. You are a homeowner. And at the same time, banks are making more money because they're selling more mortgages. Wall Street is making more money because they're turning around, chopping up these mortgages and turning them into other financial instruments. And the government is happy because now more people are buying homes, more people are paying property taxes, and everything looks good. But when you have a lot of people owning a home that can't afford to own a home and the economy slows down, that's how you get a repeat of 2008. Because if the economy slows down and home prices go down, now you have a whole bunch of people that are underwater on their homes because they had no equity in their homes. So they have no incentive to stay in their home and keep paying this mortgage. So people just walk away. That's when everybody starts selling their homes because they're trying to get out while they still can. And that's when you see banks starting to foreclose on people, because when you have no equity in your property and you're underwater, then people have much less incentive to continue paying a mortgage on a home that they'll never be able to pay off. Now look, I'm not saying that being a homeowner is bad or that we're about to see a repeat of 2008. I'm saying that if you cannot afford to own a home, you should not go out and just buy a home because you see everybody else buying a home, and because you see your bank offering you incentives, and because you see the government offering you incentives. Because if you go out and you stretch yourself too thin to buy a home that you cannot afford, you might be the one paying the price if things turn around. Let me show you exactly what I mean. Let's start by taking a look at the average finances of the average millennial. So the average millennial has less than $5,000 in their savings account. So that is that way, I believe. 58% of millennials have $5,000 or less sitting in their bank account, which means you have a lot of millennials with a big fat zero in their savings accounts. And when it comes to investments, the average millennial has something right around $23,000 in their retirement account or investment accounts. This is money that might be in a 401k or an IRA. This is just the money that you put aside for your retirement. On the flip side of things, the average millennial has something like $18,000 of auto loan debt, car payments, car loans. The average millennial has something like $30-some thousand worth of student loans because you gotta get that degree, and the average millennial who has credit cards has something like $5,000 worth of credit card debt. All these things added together leaves the average millennial, and actually most millennials fall into this category, with less than $100 left every single month to invest, to save, to put aside, to spend, to do whatever with. The average millennial is living paycheck to paycheck, and most millennials do not have an extra $100 every single month to put aside for their dreams or anything else. Now, I already made a video where I talked about why the average millennial is financially screwed and what you can do about it. So if you want to watch that video, I'll link it for you in the description below. But what you got to understand here is there's a lot of factors leading to this. I mean, obviously we have wages that are not keeping up. We have a higher standard of living. We have all these extra costs that people before us didn't have, like student loans. People in the generation before us didn't have to go into debt $30,000 to get a job paying $25,000. Plus, the generations before millennials also didn't have to deal with all this money printing by the government and the Federal Reserve Bank, which dilutes the value of your dollar. And previous generations also got retirement handed to them in the form of Social Security and pensions, while millennials did not. So there's a lot of factors leading to the fact that millennials are struggling financially and they're having to put off their home buying decisions because they don't have the money for a down payment. This is where you're going to see more and more programs created to help millennials in this situation become home buyers. And so you're going to see things like banks lower their down payment requirement. It's already down to like 3 or 3.5%, and there's a good chance you might see this come down even more over time because young people are struggling to be able to buy a home. Now, this sounds nice because now you can buy a home with a very little down payment, but you have less equity in the game. And same with the government. The government's working hard to create new down payment assistance programs and home buyer assistance programs to give millennials essentially free money. That way you can go out and buy a home. This is where everybody says, if you can go out and buy a home with little to no down payment, why in the world would you not buy a home? Because when you're renting, now you're paying someone else's mortgage, but if you buy a home, now you can get this mortgage and now you can build this equity in this property, and now you're building your wealth while you're paying your housing payment, versus when you rent, you're just building someone else's wealth. When you're buying a home with little to no money down, then yeah, it's really similar to renting because you don't have to put down a huge down payment and you also don't have that much skin in the game. Now, when you're paying this mortgage payment, your money is going to hopefully build you equity in this property because some of your money is going towards your principal. But if things go wrong, where if home prices go down a little bit and now you're underwater, now if you're not able to make a mortgage payment, either because you lose your job or because you have to refinance and the payments go up, whatever, you cannot make your housing payments anymore. Now moving out becomes a much bigger mess. Let me clean off my whiteboard and show you what I mean. So let's say we're talking about you living in this lopsided $200,000 home. If you wanted to buy this home and you put down 3.5%, that means you're putting down $7,000 as your down payment, and you're gonna take out a mortgage for $193,000. Now, because you're only putting down 3.5%, you're gonna have to pay additional fees like PMI, and then on top of your mortgage, you also gotta pay property taxes and insurance. But add that all up, and if you can get a good interest rate, you'll be paying something right around $1,200 a month to own this property. Now, this is for buy. If you went out and you rented this property, this would probably cost you something like $1,500. And so in this case, it makes sense. Okay, why in the world would you want to rent when you got to pay more money when you could buy the property and own the home while building your own equity in this property? The first part of the answer is really more of an economic answer, because if something were to happen in the real estate market or the economy where property values went down 20%, so now they came down to $160,000, this home is now worth this instead of that. Now this might seem really weird because people think that real estate prices always go up, but we know that's not the case. Remember 2008? But assuming, let's say real estate property values went down and your property value goes from $200,000 to $160,000, now you're underwater. And let's say now you want to leave the property, you can't sell the home because you bought this home and you owe in the beginning $193,000. So if you don't have enough equity in the property, then if you sold the home, you're going to have to give the bank a big check at closing, and chances are you don't have the cash to do that, because if you did, then you would have put some more money down. So you can't sell the property, which means if you wanted to get out of this property, it is going to be very hard, and this is what causes a lot of people to start walking away from their homes. And so now you would just lose the $7,000 down payment. On top of that, have to deal with a short sale or a foreclosure. And if you go through a foreclosure, it is a very painful process, and you're going to see your credit score dinged, and it's going to stay on your records. If you're renting this home and you need to get out, you have a whole lot less to lose. You just got to negotiate with your landlord about how you can leave, and then you don't got to sacrifice your down payment. You might lose a security deposit here, but you also don't have to go through a whole foreclosure process. But now if we dig a little bit deeper, what you're going to see is that this actually isn't a very fair comparison, because people don't look at buying and renting the exact same home. Because some person's going to look at this and they're going to say, wow, I can qualify for this home and a mortgage where I only have to pay $1,200 a month for this property, versus I can afford to pay $1,500 a month through renting it here. And so what happens a lot of times is this person thinks, wait, why don't I just go out and buy a little bit of a bigger home, because I have extra money that I can pay towards my monthly payments. And so instead of paying $1,200 a month for their mortgage, they go out and they buy a bigger home, $250,000 home or a $300,000 home. That way they can stretch this as far as possible to $1,500 if that's what they can afford to pay, because we all know that your home is an investment and home prices never go down. And if you're buying a bigger home, now you're just building equity in a bigger property. So now you're going house hunting and you're looking at properties with a real estate agent, and they're looking at you like, why would you want to buy this $200,000 home when you could buy a much bigger home? And the banker is going to want to get you approved for the biggest mortgage possible, because that's what gets them the biggest commission as well. And so now you're going to be stretching yourself thin, because you're going to be looking at the numbers like this. I would have paid $1,500 a month for rent, so I might as well pay $1,500 a month for my property, my mortgage, my insurance, and my taxes, because that way I'm getting the same size home. And now at least here you own something where you're building equity. But there's another cost to owning a home, because when you own a home, you're also responsible for all the repairs and all the maintenance. And so when the AC goes out, you have to pay $4,000 to fix that. When the furnace goes out, you got to pay $4,500 to fix that. When your roof breaks, you got to pay $10,000 to fix that. And if you remember the chart I was showing you before, almost 7 out of 10 millennials don't have $100 left over in their bank account every single month. And so now when you're a homeowner, you have homeowner responsibilities. And if something goes wrong and your AC goes out and you have to pay to fix that, but you don't have the cash to fix that, what happens? Well, now you got to refinance and get another loan on your property, or you're going to have to put this on your credit card. Again, when times are good, this works just fine, because now you don't have to put down a ton of money for your down payment, and instead of paying rent, you're building equity in your own property. But as soon as things go bad, what often happens is many things go bad, and then you're going to be the one to pay the price, because you couldn't afford to own the home in the first place. Because now if property values go down, now you're paying a mortgage on a property where you're underwater on, and you're going to feel kind of like you're drowning, because you're going to feel like you'll never be able to catch up, because it'll seem like property values keep going down. And at the same time, your AC might break or your furnace might go out, and now you have this $5,000 cost that you don't have the cash to cover. And if the economy is slowing down, then there's a chance that you might lose an income stream in your home. And now not only do you not have the cash to pay your regular payments, you don't have the cash to cover your AC, and you're underwater on your property. So what happens? Well, these are the people that are the first to walk away from their homes, because they have the least to lose. Look, banks, the government, and Wall Street want everybody to be a homeowner, because that's how they get paid. I want you to be a homeowner when you're ready and when you can afford it, because now even when things go wrong, you are gonna be able to sleep at night because you can afford the home that you live in. So I want you to be a homeowner, but I want you to be a smart homeowner. The way you do that is, first, when it comes to your down payment, the first thing is you gotta have 20%. Now I know this is hard, 20%. That's $40,000 on a $200,000 home. But if you have a 20% down payment, now you have some serious equity, some serious skin in the game. So even if the economy slows down and real estate prices go down, you are okay. And also, when you have a 20% down payment, you don't got to worry about paying higher fees like PMI and other things like that that banks charge on you when you don't have a big enough down payment, because now banks understand that you are a qualified buyer. So not only are you going to save money on your mortgage payments because you don't have to pay PMI, but you also have more equity in your property already. The second thing you got to look at if you really want to be able to afford your home are your monthly housing costs. This is your mortgage payment and everything else. If you really want to be able to afford your home, you want this to be less than 25% of how much money you're making every single month. And remember, when we're talking about your mortgage costs and rent, there's more to home ownership than just your mortgage costs. You have your mortgage costs, you have your property insurance, you have your property taxes, and you have your maintenance. So these are things you got to factor into your costs, because comparing your rent to your mortgage is not comparing apples to apples. You got to understand all the costs that are involved in owning a home, and when you're a homeowner, you also have the responsibilities of being a homeowner. So you got to make sure you understand that you got to afford the monthly payment, okay? Just because you can qualify to own a home does not mean you can afford it. In a good economy, yeah, it's great. It looks like property values are going up, you're building equity, and everything is just fine. But when things slow down, you're going to be the first to pay the price, and you don't want to be in that situation. You want to be a timeless homeowner where you don't got to worry about losing your home, and you don't got to worry about how you're going to make your housing payments. You want to own your home the right way, meaning you want to be a smart homeowner, so you got to afford the down payment and you got to afford the monthly payments. And finally, the third thing you got to have if you want to be able to afford the home you live in is you got to have some savings. A minimum of 3 months worth of expenses saved liquid in your savings account. This is not money in your stock account or your investments accounts. This is liquid in your savings account. That way, if things were to go bad, if you were to lose your job and the stock market crashed, you have money to fall back on. That way, you don't got to worry about how you're going to pay these mortgage payments, because you have savings to cover that. If you don't have savings, then when things go wrong, when your AC breaks, when your furnace breaks, when your roof goes out, you're not going to have anything to fall back on. Because the thing you got to understand about owning homes is things break, and you don't want to have to go into debt when that happens. So you want to make sure you're protected by having some savings so you can fall back on it when things go wrong. This is where we really start to hit a dilemma, because people want to be homeowners naturally, but at the same time, it is very hard to be able to afford a home like this, because it's very hard to save up $40,000 when you can only put aside $100 a month. So there's two things you got to do to be able to afford your home. First is you got to spend less money. Okay, if you are spending a whole bunch of money on things you don't need, maybe you have a bigger apartment or a bigger home than you need right now, or maybe you're spending a lot of money on accessories and an expensive lifestyle that you don't need, start cutting down on things that you don't need. That way you can save up money for your down payment. On the flip side, you got to also work to earn more money. Maybe that means taking on a second job. Maybe that means starting a side hustle. Maybe that means asking for a promotion or asking for a raise. These are things that you can do right now to start adding some more income into your financial system, because you need to have some extra cash. That way you can afford the home that you live in. I can't predict the future, but chances are you are going to see more and more incentives created that help young people, especially millennials, be able to afford a home, because millennials not being able to afford a home normally is a big problem. And it's going to slow down the banking industry, it's going to slow down Wall Street, and the government's not going to be happy about that. So chances are you are probably going to see more programs created to help millennials buy homes. Now, while these sound good on paper, you got to understand that these things do have costs, and you don't want to be the one of the people that's paying the price of this cost. You got to understand what's going on and be smart with your money, because it's not your banker's job to be smart with your money. It's not your real estate agent's job to be smart with your money. It's not Wall Street's job to be smart with your money, unless you're paying them to do that. But even then, it's not Wall Street's job, and the government doesn't do the best job at taking care of you. This is why you got to be smart with your money and understand what you can afford and when you're ready to be a homeowner, because you want to be a timeless homeowner where you don't got to stretch yourself too thin and start living paycheck to paycheck just because you're a homeowner, and you don't want to ever worry about having to lose your home. Retirement is a really weird concept. Personally, I hate the whole idea of traditional retirement, where you work from the age of 21 until 65 or 67, and then once you hit that age, then you can quit your job finally and then do nothing until you die. Well, I guess some people look at retirement as the time when they'll finally be able to travel and finally be able to go enjoy the world and enjoy their lives. But why do you want to start enjoying your life when you're old? This is one of the reasons why people say those who retire early die early, because because when you're sitting in retirement with nothing to do except watching reruns on TV all day, every day, you feel like you have no purpose. I would much rather like to see you change the whole idea of retirement from working this job that you hate for 45 years so you can ultimately quit and do nothing, to doing something that you love, and then when you hit retirement or financial freedom, that now you can kind of scale back while continuing to do what you love while spending more time traveling and spending more time with your family. If all you know is your job and this is what you're looking forward to day after day after day, then when you hit retirement, it is going to be a very sad day, because then you're not going to be able to go back to your job and you're going to feel like you have nothing to do. Like, there was an uncle of mine who used to be an engineer, and he worked this engineering position for decades. And as soon as he retired, he immediately started having all these health problems because he was doing nothing except sitting on the sofa and watching TV all day long. And so he went from this healthy person to immediately becoming this old person, like almost overnight, because he started having so many physical health problems. He went into depression, and it created all these problems just because he hit retirement and had nothing to do. Now, while that issue is kind of like, what do you do in retirement and how do you live your life? The second issue is the financial side of the issue, because CNBC has made it clear that millennials are financially screwed when it comes to retirement. Well, at least the people that don't understand money, that is. The whole idea of retirement, strictly financially speaking, is you can now live life the way you want without having to worry about money, because you have built up this nest egg, these savings or this investment or whatever. This income or this nest egg that you have created will now be able to fund your life. That way you can live your life without having to go to a job in order to get paid. Previous generations never really had to stress too much about retirement, because if you followed the system where you went to school and you got a good job and you put in your time at your job, then you were pretty much guaranteed a pension or social security or both, so you could be able to live your life and retire kind of without really that much stress. With millennials, it's a little bit different, because now you got to plan for your own retirement, and if you don't start doing this early, you're gonna pay the price later on, and that's what I'm gonna be talking about in this video. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. So if we go back to the CNBC article, this article is based off of research from an MIT economist, which says that millennials want to retire by the age of 65. It says that a third of millennials want to retire between the ages of 65 and 69, and another 43% of millennials want to retire before 65. So you have the vast majority of millennials that want to retire at 65 or earlier. Now, you have all these millennials that want to retire at 65, but when it comes to actually planning for retirement and putting money aside for retirement, only half of millennials are putting aside more than 6% of their income into something like a 401k or any investment to help actually fund their retirement. And only 1 in 5 millennials are saving or putting aside more than 15% of their income to actually fund their retirement. But it gets a little bit worse. So what this is saying is that 3 out of 4 millennials want to retire by the age of 65. A lot of these people want to retire before the age of 65. But now, half of millennials, about 50% of millennials, are saving or putting aside 6% of their income max. So this is like the maximum amount of money they're putting into the 401k, while only 20% of millennials are putting aside 15% of their money or more into the 401k. So this other 30% is saving somewhere between 6 and 15%. So you have the vast majority of millennials who want to retire at 65, but now the vast majority of millennials are also saving or putting aside less than 15% of their income. Now, when I say saving, I don't mean putting this money into a savings account. I mean putting this money aside for your retirement into something like a 401k or your other investment accounts. 80% of millennials have less than 15% of their paychecks going towards their retirement accounts. And this article says that if millennials want to be able to retire, you got to be saving 40% of your income for the next 30 years to be able to live a retirement where you're living a lifestyle where you're just pulling out half of your final salary before you hit retirement. Now, the reason the economists are saying that this money that you're putting aside towards retirement isn't enough is because they predict that the stock market, where this money is going, right? When you put your money in the 401k, it's going into the stock market. They think the stock market is not going to grow as fast as it used to. They say that in the past, the stock market used to grow by an average of 10% a year, but in the future, they expect it to grow somewhere between 3 to 5% a year. Some companies like Vanguard actually predict that it will be below 2% a year for the next decade. That's concerning because if over the next couple of decades, when people are trying to build their wealth, you only see your money grow by 2 to 3% a year on average, then you're not going to be able to build the wealth that people were able to do in the past, because in the past, people saw their money grow by 7, 8, 9, 10% a year on average. And so that can affect how fast your money compounds, because when it comes to compounding your money and building wealth, there's 3 factors you got to look at. You got to look at how much time your money is invested for, you got to look at how much money is invested, and then you got to look at the interest rate. You cannot really change too much about the time unless you start earlier, but you cannot change the past. So the next best thing you can do is start investing your money today. When it comes to how much money you can invest, obviously you can try to invest more money, but it can be hard for some people to invest half of every dollar that they earn. And the third thing we can look at is how fast your money can grow. And if what they're saying is true, where money's not going to be able to grow as fast, then that's going to hurt a lot of people when it comes to building long-term wealth. Let's take a look at it. Let's assume that you are making $50,000 a year. And for the sake of this example, I'm going to assume that there's no inflation in this world. So you are going to make $50,000 a year every single year until it comes time for you to retire. And I'm going to assume that you are investing 15% of every dollar you earn before taxes. So 15% of $50,000 means you are investing $7,500 a year. If you can do this, and you do this for the next 30 years, well, over those next 30 years, assuming you get a 2% annual return on your money, then your money is going to grow to $323,000. If you can get a 3% annual return on your money, then your money is going to grow to right around $380,000 when it comes time for you to retire. Now the problem here is if you want to live off of $50,000 because this is what you're used to, this is what you've been making every single year, then even if you make 3% a year on your money, then this money is going to last you less than 8 years when it comes time to retirement. So if you retire 65, you're going to be broke by the time you're 75. And even if you're living off of just half of what you made as a salary, so if you're living off of $25,000 a year, you're still not going to get 20 years worth of income from this money, assuming you don't keep investing your money when it comes time to retire, because you move your money into something safer like bonds where you're getting even lower returns. If that's the case, then this money is not going to take you to 85 years old. You're going to be broke in your golden years of retirement. If what these economists say is true, that millennials are only going to see a 2 to 3% return on their money over the next few decades, then this is very, very, very bad news for millennials, especially because only 1 in 5 millennials are putting aside 15% or more for retirement, while the vast majority of millennials are doing way less than that. Now, if you are a millennial and you're watching this, there are things that you can do. That way you can get better returns on your money. And I'm going to get to that in just a second. But the reason why these economists and these financial institutions are kind of predicting these lower returns in the future is because they think that our United States economy has grown so big that we're not going to be able to grow as fast. You can kind of think of our United States economy like a company, because when a company is small and is in the startup phase, it can grow a whole lot faster than it can once it becomes mature and bigger and older. Like if we look at Amazon, for example, in the first decade that Amazon was in existence, they were growing by 100% a year. But now that they're so big, you're not going to see them grow by 100% a year every single year over the next decade, because they're so large. There's not that much market share that they can grow by that quickly. So the bigger you are, the harder it is for you to grow as fast. That's why when you invest your money into blue chip stock, like a bigger company, something like McDonald's, you're not going to expect to see your money double overnight. Versus if you invest your money into a startup like maybe Tesla or Peloton, you can see your money grow a whole lot faster, because these companies have the ability to grow a lot faster because a lot of people are not buying or using their product yet. And so they have a whole lot more market share that they can take, and so they can grow very quickly. So the smaller you are, the more potential you have to grow faster. If you look at the United States economy back before the 2000s, you would see our GDP, our economy, grow by 5, 6, 7% a year. But now we are happy when we see our economy grow by just 2% a year, because our United States economy has become so large. I mean, we are a massive economic superpower. And when you become that big, it becomes so much more difficult to maintain that same rate of growth that you saw before. And so in order to keep growing quicker, you might have to take on more risk. I already made a video talking about how our economic system works. If you want to learn more about that, I will link a video where I explained it in the description below. So the whole idea is because our economic system and our economy is so big now, we can't grow grow as fast as we once did because our economy is already so large, and so we kind of have to expect smaller returns. But just because that's the case for the overall economy doesn't mean that you have to accept these smaller returns, because there's other things that you can do with your money to kind of balance this out and get better returns for yourself. Now look, I gotta give you a little bit of a disclaimer here, because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you gotta always do your own due diligence and never blindly listen to a random guy on YouTube. In general, higher risk comes with higher potential return. So what you want to figure out is how you can get this higher potential return while kind of mitigating your risk. One way that you can mitigate this risk is by learning and finding alternative investments that can get you better returns, and because you learn and know how to do this, you can lower the risk while getting the higher returns. One thing that we're going to see over the next decade is cheap money. I mean, we have interest rates that hit rock bottom in 2020 and 2021, and they're going to stay low for a long time, and so we have this huge influx of money into our economic system, and this money has to go somewhere. One of the places this money can go is into startup companies, and so startup companies can borrow money very inexpensively and use this to start and grow companies. There's a couple different ways that you can invest in these innovative and growth companies. You can go out and find the individual companies to invest in. So you can go out and find these startups, and you can do the research on them, and you can study their financials, and you can see who is a good person to invest in, who is a good CEO, who has a good executive team, and when you find a company that you like, you can invest your money into it. But then you also got to do the upkeep. You got to listen to the earnings calls. You got to see how much money they're making. You got to see how they're innovating, because you want to make sure that your money is in a good place. I don't recommend this for the majority of people, because this takes a lot of work and a lot of time. And if you're not willing to put in that work, then you are taking on all the risk without mitigating it. Because when you're investing in startup companies and these innovative companies, there's a high chance that these companies can fail, because it also comes with more risk. The alternative is you can invest in an ETF, which is a fund that gives you exposure to a bunch of different companies. So there are ETFs out there that gives you exposure to growth companies and innovation companies. So these are ETFs that give you exposure to a whole bunch of different companies, a whole bunch of different stocks. So if one company in your fund goes down, then you're okay, because this fund will have a whole bunch of other companies, but you're getting exposure to a general group of stocks. So there are ETFs that give you exposure to growth, like VUG. This is a Vanguard fund. And there's innovation ETFs like ARK. Again, these are just examples. I'm not telling you what to invest in, but I do got to let you know that I do have some of my own personal money in this ARK fund. But these are funds that you can invest in that will give you exposure to growth companies up here or innovation companies over here. ETFs work just like stocks. You can buy and sell shares of these ETFs right on your stock brokerage. And if you go and do a little bit of research, so do a Google search on either of these ETFs, you'll see what companies they invest in and what their investment goals are. The thing that you have to understand when it comes to investing your money in ETFs is your goal here is long-term growth, because ETFs are not things that you should be day trading. These are things that you want to be investing your money in for the long term, because you believe in the companies that these funds are investing in. So you believe in innovation, and you believe in growth, and you like the companies that these funds are investing in, and so you want to own a piece of that fund to have you get exposure to these companies. And the key for this to work is you got to keep consistently investing some of your money. I say at least 15% of your income every time you get paid into these funds, and this is something you got to be doing for years, right? Because we're talking about building this financial freedom, and so the goal here is not to see your money go up in a month, is to see your money grow consistently over the years. Now, before I get off the topic of these ETFs, if you do want to learn more about how to invest your money in ETFs and how ETFs work and how you can find a brokerage that automatically passively invests your money into an ETF like this for you every time you get paid, that we don't got to worry about it, our team wrote an amazing article that will walk you through exactly how to do that, and I'll link it for you in the description below. The third way that you can beat the returns of a slowing stock market is by investing your money in real estate. But there's a few different ways that you can invest your money in real estate. One way is through REITs, R-E-I-T. I'll explain what that is in just a second. Another way is through crowd-funded real estate. And the third way is through rental properties. I gotta get me a new black marker. REITs stand for Real Estate Investment Trusts, and these are things that trade on the stock market. Now, when you invest in a REIT, you're not investing in an actual property, you're investing in a company that invests in real estate. So you can invest in REITs that invest in apartment complexes, you can invest in REITs that invest in strip plazas and commercial buildings. There are REITs for all different types of real estate. The interesting thing about REITs is that REITs are required by law to pay out 90% of their taxable income, so the rental profits, to the shareholders, people like you, through dividends. And so many times you're going to see REITs that are paying out dividends more than 3% a year. This is in addition to stock price appreciation, which you're hopefully going to get. So when you buy shares of a REIT, you're going to hope that the price of your shares go up. But in addition to that, every 3 months or whenever they pay out a dividend, you are going to make this passive income. Crowdfunded real estate is a little bit different. This is a way for you to get exposure to physical real estate without having to buy an actual property yourself. So what you're doing here is you're investing your money into a fund. This is not something you do on the stock market. You got to use a crowdfunding service. I'll have articles and resources for you in the description below if you want to learn more about how to do that. But you're investing your money into this fund, which gives you exposure to physical real estate. So you might be investing in a fund that gives you exposure to prime time apartment complexes in Miami, or it gives you exposure to prime time developments in LA. Essentially, you're investing your money into something that gives you the same returns that a physical property is giving you. The advantage of this is now you will get appreciation and dividends from your rental income. And you don't got to worry about dealing with tenants or finding properties or dealing with property managers. You're just investing your money into a fund. The third way that you can grow your money faster is by investing your money into rental properties, especially value add rental properties. So this is my favorite place to invest my money. When you invest your money into a rental property, you're going to buy a physical property, let's say a house. And once you own this property, you can lease this property out to somebody else so a family can live in your house. And every single month, they're going to have to pay you rent for living in your property. So not only are you getting passive income, but if housing prices go up and real estate prices go up, your property values are going to go up as well. Now, to put this in perspective, if you invest your money into a REIT, typically you are going to see dividends paying you somewhere between 2 and 10% return a year. The higher the dividends, the higher risk, but these are pretty standard when it comes to REITs. So somewhere in the 2 to 10% a year, and this is consistent passive income you're gonna get for just investing your money into a REIT. When you invest your money into crowdfunded real estate, you're typically gonna see somewhere between 6 to 9% a year. At least this is what I've been seeing in the past, and I have some of my money in crowdfunded real estate, and these are the type of returns that I've been seeing. And when it comes to rental properties, this is really going to depend on which area you're in. But if you're in a big city, you're going to see lower returns. If you're in somewhere like the Midwest, then you can see much better returns. Me, personally, I'm looking for something between 7 and 8% cash flow a year. The reason I like this is because this number typically goes up over time because rental prices go up, and so you make more money and you own something physical and tangible. Plus, when you own physical real estate, you also get tax breaks because the United States tax code gives a lot of loopholes to real estate investors. Now, I know this is not easy. This is more work. This is going to require effort on your part to learn how this works and actually put in some time and some money to invest here. And yeah, you're going to go through a learning curve. There might be times where you lose money. I even talked about my worst real estate deal ever on YouTube. There are times where you will lose money, but these are things you got to go through if you want to be willing to get the higher returns. That way you can actually build your wealth. Because if what these people say is true, and you're only going to see 2 to 3% returns over the next decade or decades on average, then it's going to be much harder for you to build your wealth. And so this is where you got to really break away from the majority of people. I mean, that is why we call ourselves the minority mindset, where now you are taking care of yourself and your finances, because you do not want to run into a situation where you have to rely on someone else like the government. That way you can be able to live your life. This is where financial education is so important, because most of us are never taught about the different ways that we can grow our money. We're just taught to go to work and invest our money in our 401k. But if that's not working, or if it doesn't work in the future, you gotta know how to start planning your money today. That way you can live the life you want when you want. People love to rip on millennials for being bad with their money. But there's a lot more to what's going on with millennials and money than just millennials blowing all their money on extra guac and Starbucks. I mean, we all know that Jeff Bezos became the richest person in the world because he skipped out on 100 billion lattes and saved that money in his bank account. What's even more interesting is that millennials, on average, are making more money than any generation before them, but at the same time, millennials have less wealth than any generation before them. Like, millennials own something like 3% of the net wealth, while baby boomers, when they were younger, they owned something like 21% of the net wealth in this country. And this divide between the haves and the have-nots is just accelerating and getting bigger. And what you'll see is this divide is actually just between the financially educated and the financially illiterate, but I'll get to that in just a minute. But even Newsday reported that in the mid-2000s, people that were under 35 then had more wealth than people did today who are under the age of 35, and this is adjusted for inflation. So what happened between the time when baby boomers were young and now, and even more so the mid-2000s and now, which is making it harder for young people and millennials to build wealth? And if you're Generation Z or watching this, you might be reading these news headlines thinking, wow, I'm even screweder, which is why it's important for you to watch this video. But what's going on? What happened? What caused this? Well, if we just focus in on the last couple of decades, which is when we really started to see this divide accelerate, a few things happened. First, we saw some major recessions, like the 2008 recession and the 2020 pandemic and recession were both once-in-a-lifetime recessions that millennials were lucky enough to live through twice. And to kind of combat these recessions, we saw massive quantitative easing, which means money printing. You'll see why that matters in just a minute. And during this time, in the last couple of decades, we saw a massive increase in the standard of our living because technology boomed. And with all of this also came cheap debt. So let's jump into this. What's really going on and what can you do to build your wealth? But before we get into that, I need you to do me a quick favor and smash the thumbs up button below. And a quick word from our sponsor, Webull. If you are interested in investing in stocks, Webull is giving you free stocks for opening a free account and investing with them. If you want to learn more and see how you can start investing and get your free stocks, I got the link to how you can do that with Webull in the description below. But there's a couple kind of like hidden costs of a recession that most people don't think about when they think about the cost of a recession. The first of which is a changing job market. Because if you spent a number of years working a certain position and now this recession comes in and it wipes out that position, now you're kind of like starting over in the marketplace trying to figure out how to have a career and how to make money. Like just take a look at what happened after the 2020 pandemic. You had entire industries that were obliterated. Like the retail industry was hammered, the hospitality industry was smacked, and the travel industry was hit so hard where now people that were working in these industries or were getting experience in these industries now were having to start new career paths somewhere completely different where now they have to start kind of as an entry level again. So if you're a young person and you come out of school thinking, I want to be in the hotel industry, and you start working in the hospitality industry trying to learn how hotels work, and then this pandemic and this recession comes in and this entire hospitality industry gets smacked, now you might have lost your job, and now you have to look for a new career, and now you're starting off somewhere brand new. Now, of course, there's winners and losers when this happens. Like anytime you see a recession happen, you see winners and losers. Like when a market crash happens, you see a lot of losers. People lose money when they panic sell on the bottom, but it also creates a lot of opportunity for people that think different when they come in and they buy at the bottom, because now you get to buy assets for dirt cheap. Just like that, when the job market changes, you see winners and losers. When the 2020 pandemic happened, the clear winner was the tech industry because everybody was home and they were spending a lot of time on their computers and their iPads and their cell phones. And so the tech industry boomed because everybody started doing everything digitally. That's why they say more millionaires are made during economic crashes and recessions than any other time, because recessions allow people to think different, the opportunity to come in and find the opportunity and seize it. But at the same time, they also hurt the people that don't think different, the people that kind of just follow the traditional path because they don't see that opportunity. And so now when you have multiple major recessions happen, the people that think different, that have the minority mindset, are able to thrive because they find the opportunity. But other people that don't necessarily see that opportunity or are on the wrong side of the equation just because they work in a certain industry or a sector, they get smacked and then they have to pay the price. So on one hand, you have this changing job market that just gets accelerated when you go through a recession, and some people just were not ready for that. I mean, not everybody can work in the tech industry, and some people just didn't want to. But now, because of what we saw happen in the 2020 crash and because of the changes that happened after the 2008 crash, people had to change their careers massively, and this completely changed the job market. The second thing has to do with quantitative easing. In order to combat this recession, we saw a whole lot of money printing by the Federal Reserve Bank and the government in order to stimulate the economy. When the 2008 crash happened and our economic system was on the verge of collapse, the United States government worked with the Federal Reserve Bank to fund the biggest bailout in the history of the world, which meant they printed hundreds of billions of dollars to help stimulate the economy. Now, when that happened, it was absolutely mind-blowing to think that the government could fund these hundreds of billions of dollars with the quantitative easing. Then, when the 2020 pandemic and recession happened, the United States topped that with a multi-trillion-dollar stimulus plan, which means over this couple decades, you saw trillions of dollars printed by the United States government and the Federal Reserve Bank, and this cash was injected into our economy. Now, on one hand, this sounds great because it stimulates the economy, it gets businesses going, it gets money into the hands of people, so now people have money to spend, it gets the economy going, and our economy looks like it's going back to normal. But this is probably one of the biggest reasons why you see this kind of divide in wealth between young people in the mid-2000s and now because the value of our dollars have been diluted because of all this money printing that has happened between 2008 and the 2020s. We all go to school to learn how to be productive members of society, and the extent of financial education that most of us get is to not spend all of our money and to save some of our money. And then we get a job, and then we're just told to invest our money in our 401k. But this financial education, or this lack of financial education, is a big reason why you're starting to see a bigger divide between the haves and the have-nots, because the majority of people are going to work every single day just so they can save a little bit of money. But what people are starting to really realize now is that your savings don't have as much buying power as they used to. Every time more dollars, or what you and I call money, is printed, the value of each dollar that you have and the value of each dollar that you work so hard to earn goes down a little bit. This is what inflation is. As more money is printed, the value of your dollars and your money gets diluted. And so now you need more money to go and buy groceries. You need more money to go on a vacation. You need more money to have a place to live. And so as more and more money is printed, the value of each dollar that you save, the value of each dollar goes down, which makes the cost of living go up. And at the same time, the majority of people don't understand this. They don't see this happening. So what do? They continue working hard at the job just to save a little bit of money. And these are the people that are becoming poorer because of the system, and they don't even see it happen because you're not using your money in a way to build your wealth. Your money is just sitting in the bank and it's getting eaten away by inflation. And so yeah, you thought you saved $10,000, which sounds great, but $10,000 today doesn't stretch as far as $10,000 did 20 years ago. So now you have the price of things constantly going up because dollars don't have as much buying power as they did before, and the majority of people don't understand this. So the majority of people keep going to work to save some money, but they don't realize that when they do that, they're just shooting themselves in the foot because your money is losing value. Your money is a liability in the bank because it is slowly getting eaten away by inflation, while the people that understand what's going on take their extra dollars and they convert it into other assets, which are things that grow with inflation, or they grow into things that make them more money. So the majority of people think they're doing the right thing by saving their money, but they're actually the ones losing in the system because everybody else who was using their money the right way is becoming wealthier, while the majority of people are becoming poorer. So not only do you have people lose a big chunk of their life savings who sell during a recession, but you have a constantly changing job market. You have all this money printing, which causes increasing inflation, which makes it harder for people to buy things. But you also have an increasing standard of living because over the last couple of decades, we saw this boom in technology. And so now, not only do people have your basic costs of a home and a car, but people also have a fancy laptop, a smartphone, a smartwatch, your AirPods, and you gotta have your Lululemon leggings with that too. This point opens up a whole new wave of debates because people say, okay, you are a middle-class person today, and maybe you don't have a lot of money in the bank, and maybe you don't have a lot of investments or assets or wealth, but you do have a nice home. And your home has AC, and you have a nice car, and your car has a touch screen in there, and you have a nice laptop, and you have a nice phone, and so you have nice access to all these nice things which increase your standard of living, but you don't have kind of wealth. Compare that to somebody 50 years ago who didn't really have all these things. A middle-class person 50 years ago might not have had a nice car or a nice home. They wouldn't have a touch screen or any technology. So even though you're middle class and maybe not as wealthy as people were a couple of decades ago, you still have a better standard of living. Personally, I just think that's a dumb argument. Of course, I would rather be middle class or poor today than middle class or poor 50 years ago, but I want to know, how can I have the nice things and have the wealth? This is what financial education is all about, understanding how to use your money. And so now we have already these higher costs of living, but we also have this higher standard of living because now you have the majority of people, especially young people, that now see everybody else have the AirPods, everybody else has the MacBook and the iPhone and the nice car, and so everybody has to go out and buy these things because they feel like they need to because everybody else is doing that. They used to call this keeping up with the Joneses. Nowadays is just keeping up with the Instagram flex, and so everybody wants to have the nice things because we have this higher standard of living. But when you don't have money to buy these things to begin with, it keeps you in this cycle of just not being able to build any wealth because all of your money is constantly going out because you got to have all the new things, and if you don't have the money to buy that, well, don't worry because it's fueled with the help of cheap debt. So cheap debt is another byproduct of recessions because when an economic recession happens, then the Federal Reserve Bank will come in and they will cut interest rates on debt. That way borrowing money is cheaper as a way to stimulate the economy, because when the Federal Reserve Bank lowers interest rates, people are more likely to go out and buy a home, they're more likely to buy a car because it's cheaper to borrow money, and they're more likely to put more things on their credit card because it doesn't cost as much as it did before. It might sound silly if you're financially educated, but it's reality. The numbers show that. It's the same with with businesses. When debt is cheaper, then businesses are more likely to borrow money and reinvest this money back into their business because now they have more money that they can borrow at a lower cost. And so when you have this cheaper debt, what happens? Well, people are more likely to go into debt. Now, again, this can be good or bad. If you're using this debt to buy assets, which are things that make you money, then it's not so big of a deal because now you can borrow money for cheap and use this money to make you more money. So for the financially educated, it's a good thing. But for the financially illiterate, this is not so good thing because now if you don't have to pay this much money in your debt, it seems a little bit cheaper. And now when you can get this debt cheap and you have this higher standard of living, what happens? Well, now you're gonna go take out all this debt and you're gonna go buy a whole bunch of liabilities, things that don't make you any money because it's cheap. The debt is cheap. This is one of the reasons why you have 20-some-year-olds and 30-some-year-olds drowning in debt at such a young age, because debt is so cheap, and so people don't see the cost of it as much because it's easier and cheaper to go out and borrow money. All these roads lead back to a lack of financial education, because if you're not financially educated, what happens? Well, when a recession happens, you lose half your life savings. When you see this quantitative easing happen, you don't even see it happen. Your money keeps sitting in your bank account and your money is getting eaten away by inflation. You have this increase in standard of living and you see everybody else buying all these nice things. So what do? You go out and buy it too. And how do you afford it? Well, with the help of cheap debt. If you're financially educated, then just everything flipped. You see a recession happen, this is an opportunity for you to come in and buy assets at a discounted price. You see this quantitative easing happen, and so now you move your money to something more valuable, like assets that will go up with inflation or that will pay you. You see this increase in standard of living in this cheap debt, and you see this, and now you're not the one that is paying for the AirPods and paying for all this technology with cheap debt. You're the one buying the assets. You're buying shares in companies like Apple. You're buying shares in companies like Amazon. You're buying shares in assets that are going to go up because you see how people are spending their money. And if you are going to use debt, you're going to use it to buy things that are going to make you money, like income producing real estate investment properties, not just a home for you to live in, but real estate as an investment that you can rent out to other people, because now you can use this cheap debt to create passive income for you. Like if we take a look at the average millennial has something like $30,000 worth of student loans. Then the average millennial has something like $18,000 worth of car loans, auto loans. And on top of that, the average millennial has something like $5,000 worth of credit card debt. That's tens of thousands of dollars of debt that millennials are working hard to pay back, that the majority of people before them, baby boomers, didn't have to pay. Like even if we look back just a few decades ago, student loans were unheard of. People weren't going into debt to go to college, and if you were, it wasn't $30,000 worth. Nowadays, when you're 17 or 18, everybody's going to college, and most people are financing this with student loans, and we don't have financial education in high school, and so people don't really realize what the cost is. And you're 17 or 18 and you're signing this paperwork and you don't even realize that you're signing a financial life sentence because of your student loans. I'll talk about cars in just a second because this is really interesting. But if you look at the credit card side of things, you have this whole new industry of banks and credit cards catering just to people who are brand new to college or brand new to the workforce. And if you don't understand how your credit card works, which is a lot of people, if you don't have financial education and you get this free piece of plastic where now you can spend as much money as you want, well, now you come out of college or you're in your 20s and you have thousands of dollars worth of credit card debt, but you don't realize it's going to take you years to pay back. Even when I was at my freshman orientation at college, all the local banks there had stalls where they were giving away all this free stuff like lanyards and balloons. That way you would want to come there because when you're a college kid, anything free is attractive, and all they want to do is sell you on their free college credit card. Even when it comes to auto loans, young people nowadays are way more likely to go out and buy a car through a loan than people did in the previous generations, because either A, people don't have the money to go out and buy a car with cash, or B, they don't want to buy a car they can afford with cash because now they can get out an auto loan and buy a much nicer car. This shifting trend in buying cars only with a loan is not good for people buying a car, because now you are paying interest to buy something that doesn't make you any money and that's losing in value, because your car is going to depreciate in value like a rock, but at the same time, It is great for financing companies and car companies, which is why all these car companies are so excited because they're seeing this boom in auto loans because young people don't have the money to buy a car with cash. So they're making so much money because now not only are they selling you a car, but they're also selling you the financing on your car. Again, while this all sounds like bad news, and it is bad news for the average millennial, and it's going to be even worse news for the average Generation Zer and the next generation after that, but it doesn't have to be all bad if you understand money and you're financially educated, because then you can understand what to do with your money. That way you're not getting abused by the system. You're the one benefiting from the system. Like we just talked about, the first thing you got to do is you got to understand your money, and you got to understand that if you're saving all of your money, not investing it, but just saving it, your money is getting eaten away by inflation. You got to have some savings. You got to have some money in your bank account as an emergency savings fund. That way if something bad were to happen, you have some cash to fall back on. But now you got to understand that if you really want to build wealth, you got to convert your extra cash, your extra money into something that's going to make you money. Assets, stocks. Now you can own a piece of the company where everybody else is spending money, and you can own real estate. Real estate is a hard asset that will also produce you income. And so now you got to understand, you got to get the shift of just keeping your money in the bank to now owning the assets that are going to produce you with income and value. Once you start to do that, your mindset's going to change, because before what probably happened is anytime you have money in the bank, you were probably thinking, all right, what can I do with this $2,000? What vacation can I go on? What kind of new car can I get? What upgrades can I put in my car? And you're always thinking in terms of products. Now what you're going to start doing is you're going to start thinking in terms of assets, because what might happen is you might start investing in real estate, and you might see that you're making $300 in profit per unit that you own. And now you're thinking, wow, this is $300 that I'm making completely passively. And if I can just have 10 units like this, then I can make $3,000 a month passively. If I can have 100 units, I can make $30,000 a month passively in profit without me doing anything. And now you're going to be trying to get in these wheels spinning, thinking, what do I got to do to get 10 units? Or what do I got to do to get 100 units? So you're going to be doing everything you can to do that. And that's where you got to understand that you got to stop blowing your money on everything that's not making you money and really start focusing on the things that are making you money. That means you got to start buying assets instead of liabilities. This is where you're going to shift how you spend your money, and now you're going to stop blowing your money on a whole bunch of things that you don't need, and you're going to start using your money to actually build your own wealth. Now when you do this, at this point, you're going to think, I'm making great money from my investments and my assets. How can I supercharge this? How can I make this grow even faster? Now you're going to try to look for other ways to earn more money. Maybe you're going to look for a promotion at your job. Maybe you're going to look for a second job. Maybe you're going to look for a side hustle. Maybe you're going to start your own business. And so now what you're trying to do is you're just trying to fuel your financial system. Because when you don't have the financial education, you're going to be doing the 4 things that I talked about on this whiteboard before I wiped it off. You're going to be losing all your money in recessions instead of looking for the opportunity. You're going to be the one that's spending all your money on these liabilities instead of being the one that is using your money to buy the assets. That way when other people spend money, you make money. You're going to be the one that's going into debt to finance your lifestyle instead of being the one that's using debt to make you money. I know, it sucks. We should have all been taught this back when we were in school, but we weren't. And so now this is where you have to be the one to get financially educated, because no one's going to do this for you and no one's going to tell you how to do it. Well, I mean, we do talk about this on our YouTube channel all the time. So if you haven't subscribed to our YouTube channel yet, make sure you do that. But this is where now you got to go out of your way to get this financial education. That way you can make the changes for your finances. That way you can build your own wealth. Before we get into the next clip, if you do want to learn more about money management and investing, you can download our free PDF when you sign up for our newsletter. So if you want to learn more about that, I'll put the link to that PDF in the description below. The American dream is to be a homeowner, and the dream of every media company is to rip on millennials as much as possible. That's why there's no shortage of people talking about millennials and home buying. 9 out of 10 millennials say that they want to be homeowners. Newsflash, they're not. To put it in perspective, millennials own about 4% of all real estate in America. And when boomers were the same age as millennials today, they owned about 32% of all real estate in America. On top of all that, when millennials do go out and buy a home, most of them end up regretting their home buying decision. Millennials really started buying homes during the 2020 recession because interest rates were slashed, which made mortgage rates cheaper, which made owning a home a little bit more affordable. A lot of people say that millennials don't want to buy a home because either they're bad with money, or because they want to travel so they don't want to settle down, or they just don't want to own a home. But that's not exactly true. There's 3 reasons why millennials are not able to buy homes as early as their previous generations. First is the financial side of things, because millennials have more costs cost than any previous generation. Our standard of living is so much more expensive than any previous generation. If you're a millennial, you gotta have the newest smartphone, whether it's an iPhone or Android. And if you have an iPhone, you gotta have the AirPods. And if you got the AirPods, you gotta have a Mac. And now you gotta shop at Lululemon, and you gotta have your subscription services for your fancy clothes every single month and your food delivery services. And then on top of all of that, you gotta pay for extra guac. Couple the higher standard of living with the higher cost of being a millennial. As somebody who went through a lot of schooling, from college to law school, I can tell you that education is not cheap. That's why there's more than $1.6 trillion worth of student loans outstanding, and that's why millennials are paying $393 a month on their student loans. $393 a month could buy you a house $90,000 bigger, partially because the interest rate on your mortgage is cheaper than the interest rate on your student loans. Why are your student loans more expensive than your mortgage? Well, you got two potential reasons. Either society values home ownership higher than they do your education, so they subsidize your mortgage more than they do your education, or your lender thinks that it's a riskier investment to invest in your education than they do to invest in your home, so they have to charge you a higher interest rate for you to get an education because they don't know if they're going to make their money back. Now look, financial planning plays a part, and there is a severe lack of financial education in the world, which is why I made a video going over everything you need to know about buying a home. That way you can make an informed decision, and I'll link that for you in the description below. But 50% of homeowners under the age of 36 say that student loans delayed their home purchasing decisions. Just one generation ago, it was almost unheard of for somebody to go into debt 6 figures to get a job paying 5 figures. Nowadays, you see it all the time. People go into debt $100,000 to get a job paying 40. But it's not just student loans. There are 4,800 more reasons why millennials are late to buying a home, because the average millennial has $4,800 worth of credit card debt. And what's worse than having credit card debt? Well, having more credit card debt. Between 2015 and 2019, the amount of credit card debt that millennials carried went up by 40%. So now you have a higher standard of living, and you have a higher cost of being a millennial, and you have wages that are not keeping up. Add those three things up, and now it takes you a whole lot longer to save for a down payment. Let's say you want to buy a $400,000 home. Now, if you are in California, this $400,000 is going to buy you a closet. But for the sake of this example, let's say you're in the Midwest somewhere where $400,000 can buy you a very nice home with a yard and a lot of nice space. So you're buying yourself a nice home, and if you want to get a conventional mortgage where you put 20% down, that means you're going to have to put down $80,000 for your down payment. Well, the average salary for millennial is $47,000. This is how much money you're making, but you don't get to keep all this $47,000 because the IRS wants their cut. After paying your taxes, you will be left with right around $38,000 to spend and save. Now, let's do the math. The first thing you're probably going to want to do is save about $117.50 a month for your 401k. So this is about 3% of your income every month going into your 401k pre-tax. I'll put another $1,500 a month for your living expenses. So this is your rent, your utilities, your parking. $500 a month for your car. This is the average monthly car payment in America, but I'm gonna say you're paying $500 a month for your car payment, your gas, your maintenance, and your insurance. $500 for your monthly services. This includes things like your phone plan, because everybody likes financing their phones nowadays, your gym membership, your health insurance, your Netflix, your monthly clothes subscription, and another $400 a month on your groceries, your food, and your basic shopping. If we take all these monthly costs and we put them annually, this is gonna cost you $36,212 a month, assuming no birthdays, no vacations, and no emergencies. If now you save every extra dollar that you have, it is gonna take you 40 years to save up $80,000. That way you can finally buy this $400,000 home. Now, obviously, there are alternatives. There are ways for you to spend less money. You don't have to necessarily spend all this money on services. And there are ways for you to earn more money. So there are ways that you can shorten this. But if you look at the finances of an average millennial, this is why it's so hard for people to go out and be able to buy their homes. Not to mention the fact that I did not include any student loans or any credit card payments here. This is why almost 3 out of 10 millennials get financial assistance from their families to afford a down payment on a home, while only 14% of boomers had to do the same thing. But there's one more side to this coin. Right now, we've been focusing here, how much money you make and what your expenses are. But we haven't looked at this. home values because we have stagnant wages, expenses that keep going up, and home prices that keep going up too. The blue line is home prices, the orange line is rent prices, and the red line are wages. You can see that back in the 60s and 70s, everything was kind of aligned, but then as time went on, the gap kept getting bigger and bigger. Wages went up, but not as fast as rent, and nowhere near as fast as home prices, and home prices just kept going higher and higher and higher, which is why you keep hearing people say that home values are rising faster than wages. So on the financial side of things, it is harder for the average millennial to be able to buy a home because you have a higher standard of living, you have a higher cost of living, you have stagnant wages, and you have home prices that keep going up. That's partially why Joe Biden keeps saying that he wants to give first-time home buyers $15,000 free as a credit. That way you can use this money towards your down payment to buy a home. Now, if you're subscribed to our channel, you understand that there's no such thing as free money, and there's a big cost to free money. But I've already talked about that, so I'm not going to go over that again in this video, which is why if you have not subscribed to our channel yet, make sure you do that. But if you look beyond just home values and expenses, renting is more convenient than owning a home. There's a big myth out there between the true cost of buying and renting a home. If we go back to this $400,000 home or closet in California, if you wanted to buy this, it will cost you something like $1,300 a month for your mortgage after you put down $80,000. If you wanted to rent the same home, it's going to cost you something like $1,500 a month. So if you see this, a lot of people are going to say, why in the world would you rent the home? Because it's cheaper for you to buy, and when you're renting the home, you're just paying somebody else's mortgage and you're building no equity. But you're not looking at the whole picture. When you're paying $1,500 a month to rent this home, that's all you gotta pay. You don't need to put down a huge down payment in order to rent the home, and you don't gotta pay any property taxes, and you don't gotta pay any HOA fees, and you don't gotta worry about maintaining the home. That's the homeowner's, the landlord's job. If you go out and buy this home, it's not like you can just pay $1,300 a month. The very first thing you gotta do is put down a down payment. If you get a conventional mortgage, you're gonna have to put down $80,000. If you go out and get an FHA mortgage or get one of those mortgages where you can put down less money, well, you have to put down less money, but now you have a higher interest rate, and you're probably gonna have to pay PMI. So now you have higher fees on the back end, and you don't have as much equity in the home. So the first cost you have to factor in is the opportunity cost, what you could do with this $80,000 if you didn't use it as a down payment on this home. I mean, if you have $80,000 in this situation, you can invest this money in the stock market, you can invest this money into a rental property, that way now you can get passive income. So there's other things that you can do with this $80,000 that you cannot do here, because when you put this $80,000 in your home, this money gets tied up, and now you can't put this $80,000 in the stock market or use it to buy an investment property that's going to pay you with passive income, because you're using it as a down payment on your own home. So that money gets tied up in your property as long as you're living there. Second, when you're the homeowner, you got to pay property taxes. This is in addition to the monthly mortgage payment you have to make to the bank, and when you're renting, that's already included in your rent. So that's an additional cost you have to factor in when you buy the home. When you're the homeowner, you're also responsible for maintenance and upkeep of your home, which means every 20-25 years, you got to put on another $20,000 roof. Every 15-20 years, you got to put in a $4,000 furnace. Every 15-20 years, you got to put in a $2,000 AC. Every time your window breaks, you got to pay for that. And when you're the homeowner, you're also the one paying for upgrades, because when you want to have a nicer kitchen, you got to pay for that. When you want to have a nicer bathroom with a walk-in tub, you got to pay for that. Yes, in this situation, you are building equity in this home. But in this situation, you have extra costs that you're saving by not owning a home that you can use to build equity in a whole bunch of investment homes, or you can use this extra cost that you're saving to invest in other companies that you're building equity in. So buying a home isn't always cheaper, not to mention the fact that a lot of people, when they go out to buy a home, I'm saying this from personal experience because I used to be a real estate salesperson, lots of people will want to buy a home that they cannot actually afford. That way they can show all their friends that they own a really nice home. So if you're stretching yourself too thin to buy a home, are you really saving money here? Before I go on to the third thing, I made a very in-depth video where I showed you how you can calculate if it's cheaper to buy or rent a home. So if you want to watch that video, I will link it for you in the description below. And third, millennials are just starting their lives later, which is pushing them to own a home later. During the baby boomer generation, college was almost like an exception, not the normal. Now with millennials, college is the normal, not the exception. And so people start work later and they're settling down later. In 2018, 60% of people between the ages of 25 and 34 lived with their partner or a spouse. Compare that to 1967, where 80% of people between the ages of 25 and 34 lived with a partner or their spouse. Back in the day, people were settling down and starting families a lot earlier than they were today, and so naturally people are putting off their home buying decisions with it. Now before I end this video, there's one more thing that I want to mention when it comes to millennials and money, because there's a whole media world out there that is focused on ripping millennials for being bad at their money. Now here's the reality. Are the majority of millennials bad with their money? Yes. But so are the majority of baby boomers, and so are the majority of Generation Xers. The majority of people are just bad with their money. But on the flip side, you have a minority of people, even minority of millennials, that are able to buy their dream homes with cash without getting a mortgage. The difference between somebody who's good with money, whether we're talking about a millennial or not, and somebody who's not good with money isn't just how much money you make, it's what you do with the money you make. This is why financial education is so important. You need to know how to spend your money, you need to know how to invest your money, and you need to know how to grow your money the right way. That way you can focus on building your wealth. This is unfortunately not something a lot of us are taught in school, which is why you're going to have to go out of your way to learn how to do these things. I guess what I'm trying to say here is that you should not let stigmas limit what you can do financially. There's a whole world of opportunity out there, and you got to break out of the bubble and see where the opportunities are. If you enjoyed this video, here's a video on building wealth that I think you'll love, and while you're at it, join our free finance and business newsletter, and as always, keep hustling. The more you have, the more you can do. So if you want to be able to help more people, you got to understand how wealth plays a part in that, because if you have the money and you have the resources, you can do a whole lot more good for yourself, your family, your community, and your surroundings.